All right, buckle up, everybody, because today we are diving deep into the read the market methodology, RTM for
Yeah,
short.
got it. Yeah.
And you guys, the listeners, you provided some incredible material from the RTM Academy. This stuff is dense.
Yeah.
I'm already getting the sense that this is gonna fundamentally change the way we look at trading. Forget the crystal ball.
Right.
Forget the magic indicator. This is about learning to understand the language of the market itself.
Yeah, you hit the nail on the head. That's exactly what RTM is all about. It's the idea that markets, they aren't random. They're not just a bunch of numbers bouncing around.
Right.
It's a reflection of human behavior. You got all these different players in the market, all with their own motives and strategies.
And that is what makes this so fascinating. Because one of the biggest things that jumped out at me from all this material is how many misconceptions we've all been taught about the market.
Oh, yeah.
This whole financial market fallacy thing. It's like we've been handed a faulty map. No wonder so many traders end up getting lost.
Yeah, you're absolutely right. That financial market fallacy, it's like this set of beliefs that lead a lot of traders astray. They start relying on, lagging indicators or thinking that markets are totally unpredictable.
Right.
And that's exactly what RTM is trying to challenge. It's saying, hold on, there's a better way to understand all of this.
Okay, so let's ditch the faulty map.
Let's do it.
What are some of these big fallacies that we really need to unlearn, get rid of, to start seeing the market clearly?
Okay, so one of the biggest ones is this idea that markets are totally random.
Okay.
Now, look, there's always going to be some element of unpredictability, right?
Sure.
But RTM says, no, look closer. There are these patterns of behavior, particularly from the big institutions. Those are the ones really moving the markets.
Okay.
Another misconception is thinking that indicators are the holy grail,
Right.
Indicators can be useful tools, don't get me wrong.
Yeah, sure.
But, they're based on past data. RTM says, hey, we need to read the live story that's unfolding right now in the market.
So it's more about seeing the market as this dynamic system, not just plainly following signals. Right?
Exactly. It's like, you don't just want to be reacting, you want to be understanding. And that brings us to a really crucial part of RTM, recognizing all the different players in the market. Because it's not just this anonymous crowd, right? Yeah. It's these different forces interacting, and understanding that is key to understanding how prices move.
Okay, so paint that picture for me.
Yeah.
Who are these major players in the market, and how do their roles differ?
All right, so you've got your retail traders, right?
It's you and me.
Yeah, exactly. The average folks making smaller trades. And then you have the institutions, the big guys, the hedge funds, the banks. Mm-hmm. They call them smart money.
Okay.
And these institutions, they've got the capital to move markets, and understanding their tactics, that's at the core of RTM.
This smart money concept, it's intriguing, but it's also a little unsettling.
Yes.
Because it makes you wonder, is the market kind of rigged against us smaller players?
Well, I wouldn't say rigged, but it's definitely not a level playing field.
Right.
Institutions have access to info and resources that most of us don't.
Right.
But RTM isn't about feeling like a victim. It's about empowerment.
Okay.
Understanding how these big players operate so we can, use that knowledge to our advantage.
So instead of feeling powerless, we can learn to read the signs and anticipate their moves.
You got it. It's like learning to speak their language, right?
Okay.
So you can understand what they're doing.
Okay, so spill the beans. What are some of these institutional tactics that we need to be aware of?
All right, so one tactic is they'll create these illusions of trend strength. Basically, they make it look like a trend is much stronger than it really is.
Mm-hmm.
And they suck all these retail traders in thinking, oh, this is going to keep going. And then, bam, they reverse course. Another one is called stop hunting. They drive the price down to trigger all these stop loss orders that retail traders have set,
right,
creating this cascade of selling. And then they scoop up all those shares at a discount.
Okay, so it's like they're playing chess while we're playing checkers.
Right.
Yeah, kind of like that.
So how do we stand a chance? Is RTM about, trying to outsmart these institutions?
Not exactly. It's not about outsmarting anyone. It's about understanding the forces at play and learning to ride the waves.
Okay.
One of the ways we do that is by becoming fluent in the language of price movement itself.
Okay, so what exactly is this language that the market is speaking? How do we start to, decipher it?
It all starts with order flow. This is the raw data, It tells us who's buying and who's selling at any given moment.
Right.
And this is a core principle of RTM. Imagine the market like a river. The order flows the current. When the institutions start pouring money in, it creates a strong current, right?
Right.
And if we learn to read that flow, we can get a sense of where that smart money is headed. I love that analogy. So we're not just looking at price charts, we're looking at the forces that are actually driving those changes. Yeah, you're looking deeper. You're not just looking at the surface.
Okay, but how do we actually see this order flow? Is it some kind of secret data feed that we need to get access to?
Well, real-time order flow data can be expensive.
Okay.
But RTM teaches us how to infer order flow from the footprints it leaves behind in price action.
Footprints and price action. That sounds kind of poetic. So how do we read those footprints?
That's where tools like candlestick patterns come in.
Oh, okay.
They give us this visual representation of the battle between buyers and sellers and help us see those subtle shifts in order flow.
Ah, candlestick patterns. I've heard of those, but they always seemed kind of mystical to me. What makes them so important in RTM?
They're important because they give us these visual clues about the balance of power.
Are buyers in control or are sellers in control? And RTM uses those clues to really understand what's going on with order flow. For example, you see a long wick at the bottom of a candlestick. Well, that could mean the sellers tried to push the price down, but buyers stepped in strong and prevented it from going lower.
Okay, so it's like a visual story unfolding on the chart. We're learning to read the plot twists.
Mm-hmm.
What are some of the key candlestick patterns that RTM focuses on?
There are a handful that are super important. You've got your pin bars. They often signal potential reversals.
Okay.
Engulfing patterns showing a big shift in control from buyers to sellers or vice versa.
Right.
And inverted pin bars suggesting maybe prices are getting rejected at those higher levels.
I'm starting to see how these patterns can help us see beyond just the raw price movements, right?
Yes.
We're actually getting a glimpse into what's happening beneath the surface.
Absolutely.
So we're essentially trying to figure out where the smart money is placing their bets, right?
Yeah, that's a great way to put it. It's not about blindly following patterns. It's about using them as clues
Okay.
to get a better idea of what the big players are thinking.
So we're like market detectives looking for these subtle clues in price action. What other tools or concept does RTM use to help us uncover those clues?
Well, one of the most important things in RTM is understanding market structure. It's like the underlying architecture of the market, the framework that gives shape to price movements.
Market structure. I've heard that term, but I'm not really sure what it entails. Can you break it down for me?
Yeah, think of it as the scaffolding,
Okay.
that holds everything together. It's identifying those key support and resistance levels, understanding trends, and recognizing those different phases of market cycles.
Okay, so by understanding this scaffolding, we can kind of anticipate how the price might behave.
You got it.
Okay.
It helps us identify those high probability trading setups
Okay.
and avoid getting caught in all those traps that the smart money might set.
This is all starting to click, but I have a feeling we're just scratching the surface here.
Oh, we are just getting started.
There's a lot more to unpack.
There's a whole lot more to explore in the RTM world. We've got more patterns to look at, like flags and poles.
Okay.
They're classic continuation patterns.
Right.
And then there's this concept of implied flags. They're a bit more subtle.
Okay.
They can give us a real edge if we learn to spot them early.
Implied flags. Those sound extra sneaky.
Yeah.
I'm really eager to learn more about how to spot those. But before we get into that, I think it's time for a quick break to let all this information sink in. This is fascinating stuff, but it's also a lot to process.
Absolutely.
Okay, so before the break, we were talking about implied flags and how those are like a secret signal for traders in the know. What makes them so special?
Well, they're subtle, right? A lot of traders miss them.
Mm-hmm.
But that's also what makes them powerful. So a normal flag and pole pattern, it's got that flag part, the consolidation zone. But with an implied flag, it doesn't fully form. You just see a quick move, the pole, and then a little pause. Almost like the market is hinting at the pattern.
So it's like it's whispering instead of shouting. Huh.
Exactly.
So how do we spot these implied flags before they disappear?
Context is key. Got to see that initial strong move, that's your pole.
Okay.
Then a pause that doesn't retrace too much. Price should be consolidating in a tight range, like it's gathering energy.
Okay, so what else should we be watching for?
Flag limits. These are basically the boundaries of that consolidation zone within the flag, like support and resistance levels, but just for that pattern.
So the price breaks out of those limits. Does that mean the flag is waving goodbye to the whole pattern?
Could be, yeah. Maybe the pattern's failing or something else is taking over. Like, let's say we see a bullish flag, but the price breaks down below that lower limit.
Right.
Well, that could mean buyers are losing steam.
So those flag limits are like those guardrails on a curvy road.
That's a good way to put it.
They're keeping the price contained. And if it breaks through, we better pay attention. This is making me realize how much I've been missing by just focusing on those basic chart patterns.
Right. There's always more to learn. Speaking of learning, have you ever heard of compression?
Compression, like a spring getting squeezed, ready to explode.
Exactly. That's a perfect analogy. Compression happens when the price gets stuck in a really tight range, lower highs and higher lows, like it's building up energy for a big breakout.
So how do we trade that? Do we try to guess which way it's going to go or wait for it to pop?
Patience is key. We want to let the market show its hand. Trying to predict breakouts can be dangerous, so we find those boundaries of the compression and wait for a clean break above or below.
So we're letting the market lead the dance, basically. Is there anything else we should be watching for when we see compression?
Yeah, location matters. If it's near a major support or resistance level, that breakout could be huge. It's like the compression is making that level even more important.
So it's like a little sign from the market saying, hey, pay attention. Something big's about to happen.
Right. Now, compression often leads to a big move, but there are other patterns that can signal a change in momentum. Ever heard of the can-can pattern?
The can-can.
Yeah.
Like the dance. I'm picturing candlesticks doing high kicks.
That's it. Picture the price going up strong, then pulling back a little, then surging up again. It makes this wave pattern alternating highs and lows really easy to spot, and it can mean the move is getting overextended.
So if we see the market doing the can-can, maybe it's time to step back and reevaluate.
Yeah, could be a reversal coming, or at least a period of consolidation. Now, let's shift gears a bit. RTM also shows us some of the, well, let's say the less than ethical tactics that institutions might use. You know, those tricks to shake out retail traders.
Oh, this is getting good. Lay it on me. What kind of tricks are we talking about?
One is called the BSZ, stands for breakout, stop, and zone. It usually happens around key support and resistance levels. Imagine the price breaks above resistance, looks like a bullish breakout, right? Lots of traders jump in.
Yeah, that's tempting. It's like the market singing a siren song.
Exactly. But here's the thing. The price quickly reverses, drops back below that breakout level, triggers all the stop-loss orders of those traders who bought in. That's the stop part of the BSC.
Well, they're basically using our stop losses against us. That's sneaky.
They know where those stops are clustered, and they'll push the price just enough to trigger them. Then they buy all those shares at a discount and drive the price back up.
So they're buying low after shaking out all the weak hands. Clever, but kind of devious. How do we avoid falling for that trap?
RTM teaches us to be wary of breakouts that don't look convincing. Low volume, hesitant price action after the break, that's a warning sign.
So we're looking for confirmation, not just jumping in blindly.
Exactly. Need some solid evidence before risking our hard-earned money. Another trick to watch out for is the failed to return, or FTR.
Failed to return. Sounds kind of ominous. What's that all about?
Happens when the price breaks a key level, but then instead of coming back to test it, like we'd normally expect, it just keeps going.
So it's like the price is saying, nope, no second thoughts, we're going for it.
Right, and that usually happens when you've got strong institutional buying or selling driving the price. Another clue that we need to adjust our expectations and be ready for a bigger move.
So if we see an FTR, it's time to buckle up.
Pretty much. It means the institutions are in control, and we got to respect that. Now, remember the left shoulder kink pattern we talked about earlier?
The LSK. Yeah, it sounds like something out of a spy movie. What makes it so special?
It's a sharp, almost vertical move that creates a kink in the market structure, kind of like a mini Quasimodo.
Okay.
And just like the Quasimodo, the LSK often shows up near important support or resistance levels, hinting at a possible reversal or continuation.
So it's like this little drama playing out on the chart. The forces of supply and demand duking it out.
You got it. By recognizing these patterns, we get these valuable insights into who's winning that battle. And that helps us make better trading decisions.
This is all great stuff. But I'm curious, how do we go from spotting these patterns to actually placing trades and managing risk?
Yeah.
Like, I'm ready to put this knowledge into action.
Let's do it.
Okay, so we've covered a ton of ground here.
We have.
I'm ready to actually put all this RTM wisdom to work.
Let's do it.
Let's talk trading plans, risk management, that kind of stuff.
Okay.
Where do we even begin?
Well, the foundation of good trading, no matter what method you're using, is having a solid trading plan.
Okay.
It's like your roadmap. It outlines your goals.
Right.
What are you trying to achieve?
All right.
How much risk are you comfortable with? What markets are you going to focus on? Your entry and exit strategies.
Right.
And most importantly, how you're going to manage risk.
So it's like having this set of rules
Yes.
to keep us from making like emotional decisions, those impulsive trades.
Exactly. Trading plan helps you stay disciplined and consistent. And that's really the key to long-term success, right?
Discipline and consistency. Write that down, everybody.
Yeah, write it down.
But I gotta admit, sometimes I see that big green candle forming.
I know what you mean.
My finger starts itching for that buy button.
It's tempting, yeah.
So how do we, tame that urge?
Risk management.
Okay.
That's one of the most important things RTM emphasizes is protecting your capital. It's not about getting rich quick. It's about playing the long game,
Yeah.
Making smart decisions and avoiding those huge losses that can really set you back.
Okay, so playing it smart, not reckless. What are some practical tips for, good risk management?
Well, one of the golden rules is don't be a hero.
Okay.
Avoid going all in on one trade or chasing those massive wins. Focus on taking consistent profits.
Right.
Managing your risk on each trade.
So slow and steady wins the race.
Absolutely. Another critical thing is setting those stop-loss orders. They're like your safety net.
Okay.
Limiting your losses if a trade goes against you.
Stop losses, right. I always struggle with where to actually put them. Too tight and you get, shaken out. Too wide and you're risking way too much. So how do we find that sweet spot?
Well, RTM gives you a framework for placing stops logically.
Okay.
Based on market structure. Instead of just picking a random number, look for those logical levels where the price might reverse if you're wrong.
Okay.
Could be below a recent swing low if you're going long, above a recent swing high for a short trade.
So we're actually using the market's own structure to guide our risk management.
That's the idea. And remember, stop losses, they're not about being perfect, they're about damage control.
Okay, that makes sense. Damage control. What about profit targets? How do we know when to actually take profit?
That's where understanding risk-reward comes in. We want trades where the potential reward is much bigger than the risk we're taking. Usually aim for at least a 2.1 risk-reward ratio.
So if my stop loss is 10 pips away, my profit target should be at least 20 pips away.
That's a good starting point. But of course, every trade is different. Your risk-reward will depend on your style and the setup.
Okay, that makes sense. Now, you mentioned earlier that RTM has these specific trading plans, like the reversal plan and the touch trade plan. Can you break those down a bit more?
Sure. So the reversal plan, it's all about, spotting those potential reversals using the patterns we've talked about.
Right. Quasimodos, diamonds, left shoulder kinks.
Yeah, all those. Once you've spotted a potential reversal and you enter the trade, you apply what we call the set and forget principle.
Set and forget. Does that mean we just walk away from the charts and hope for the best?
No, not exactly. It means trusting your analysis,
Okay.
trusting your plan. You set your entry, your stop loss, your profit target, then you let it play out. No need to constantly check it.
So you're taking the emotion out of it.
Yeah, exactly.
Okay, what about those touch trade plans? You mentioned those.
Yeah, touch trades, they're about waiting for the price to hit a key level, like a support or resistance zone.
Right.
And then you enter based on what the price action's doing at that level.
So you're kind of reacting to what the market's doing in real time.
Exactly. Looking for that confirmation that the level's holding or breaking, and then you go with it.
Got it. So reversal trades, they're more anticipatory.
Yeah.
Touch trades, more reactive. Both cool approaches. But even with a great plan and good risk management, trading can still be a pretty emotional roller coaster, right?
Mm-hmm.
How do we deal with that?
Trading psychology is huge. Fear and greed, they mess with our heads. We make bad decisions. RTM gets that. So it really emphasizes developing that strong trader mindset.
Trader mindset, what does that actually mean?
It's all about managing those expectations, staying disciplined, not letting your emotions call the shots.
Okay.
Focus on the process, not just the outcome of one trade.
So it's like building this mental framework that can handle the ups and downs, the wins and losses.
Exactly. Understanding that losses are going to happen, it's how you deal with them that matters.
Okay. This has been amazing. I feel like I have a whole new way of looking at the market.
Glad to hear it.
Any final wisdom you want to leave us with?
RTM gives you this powerful way to understand how the market works and make better decisions. It's not some magic formula. It takes time and effort, but it's worth it. And remember, trading is a journey. Keep learning, stay disciplined, and never stop exploring.
Love it. To all our listeners out there, if you want to up your trading game, I highly recommend checking out RTM. It could change the way you see the markets forever. And that's it for this deep dive into Read the Market. Until next time, happy trading.